So the global economy is a planetary scale Ponzi scheme. We are using both the fiat wealth of future generations by borrowing debt that we will never repay. The US debt is $35 trillion. The principal of that will never be repaid. But we're also using up their natural wealth. And so it eventually works like every other Ponzi scheme. It's great unless you're the last, generation of investors through the tent. Where sort of nature markets, natural capital come in is that the way that ceases to become a Ponzi scheme, or one of the ways, is by capitalizing on the fact that we have two commodities that are infinitely abundant and free, which is CO2 that we've already emitted and sunlight. And so a massive investment in land restoration doesn't generate carbon credits. It literally generates the primary production that is essential for all economic activity: food, water, clean air. 3 building blocks of every single cent of income of GDP that's earned in the economy. And so the better we can have people to understand that, to your point, Chris, about integrating carbon markets and other land uses, the better. Because, as you said, until we start to make those massive investments, the Ponzi scheme just keeps going until, like all Ponzi schemes, it collapses. And it's not going to be gradual. We'll wake up one day and we'll find there's no food.
Welcome back to This Week in Carbon. I'm your host, Eddie Smith, and it's a pleasure to moderate today's discussion. Today we have with us Rich Gilmore from Carbon Growth Partners and Chris Halliwell from Core Markets. And as usual, we have our weekly bestie, Rene Velasquez. And I want to thank Rich and Chris for joining us today. We've got some good topics to cover, so let's dive right into it. So right now, the biggest macro conversation is all about Trump, tariffs and trade, right? And the potential policy shifts that could impact carbon markets. And at the micro level, we're seeing questions around demand, integrity, and quality, which are all shaping investment decisions in this space. So today, I wanted to start off by asking the big question is, are carbon markets still a good investment? Right? And what are some of the key uncertainties holding people back? Would love to get you guys' take.
A great question, Eddie. I'm happy to lead off.
The top rung there, isn't he, Rich, with the biggest question in industry?
Yeah, I mean, I'd say to start, Eddie, it depends what you mean by good. Like if you're looking for an investment that's going to either get rich quick scheme, or is a stable bond paying you a risk-free coupon every year for the next 30 years, then no, carbon markets are not going to be a good investment for you. But if you're looking for an asset class that is uncorrelated and has the opportunity to deliver outsized risk-adjusted returns, huge climate and biodiversity impact with highly asymmetrical risk to the upside, then I think, yeah, absolutely, carbon markets are still a good investment. I should say that all of this is, not advice and not an offer of securities for our respective disclaimers. But as you said, there's multiple layers of uncertainty around that, which we can dive into. But Rene and Chris, any thoughts to kick off?
Chris, what do you jump in?
Look, I think I always like to frame things in the context of climate transition and the impact we're able to have in the near term to stay aligned with meaningful climate goals and retain our ecology and our biodiversity before we suffer through too much more ecological trauma. What we've not observed in recent periods is that governments have identified that compliance regulation are fundamentally, using carbon markets as a mitigation mechanism is fundamentally the fastest way to deploy capital into decarbonisation. That's not just through nature, but it's through industrial decarbonisation as well and energy efficiency. And that is purely a function of the role the carbon market can play around transfer of capital in a fast manner. in a fast, scalable manner, and finding that lowest cost mitigation and removal. And to that end, if you think of things in that context versus the alternative, which is collective failure on a climate agenda for all of us, I just don't see how you can in any way possibly suggest it's not a good investment. I guess the challenge we've had is we've had this reset, and it happens in all asset classes. It happens in all commodities, particularly when there's growth outspeeds the ability to keep up, which is very much what we saw in 2019, 2020, 21. So we need to resolve where to from here and what's the springboard for growth. But we are very much still a bull in the market.
Yeah, I couldn't agree more. And I think what you guys have highlighted is really important around the imperative for carbon markets from broader sort of context around decarbonization. What I'd say is that it's again, everything's more nuanced, right? There are very bright spots in our market. So when you look at the CDR side of things, there's a really strong forward curve and commitment that's being made. So that's really strong. They've got compliance markets that are actually starting to scale, right? And we've obviously got the I guess incumbents, let's say the EU ETS, RGGI, and California WCI. And now you've got markets emerging globally. And so 25% GDP being covered through carbon pricing systems is actually a really bullish and strong price signal. What's been lacking is the robustness of the voluntary carbon market. And that's, I think, where we're talking about in the sentiment side of things. I think that's actually a fundamental failure with regards to inclusion and participation in our market. It's all been predicated towards the core imperative, which is effectively corporates are accruing liabilities on their balance sheets, and they're looking to offset those through purchase of carbon credits. And as this sort of crisis of confidence that's emerged, it's been driven in large part through these fears around integrity. Corporates are just inherently risk averse. But what we're thinking about is actually making the participation and sort of broader distribution of carbon markets more accessible. So including folks, for example, within retail, as in crypto also has a really strong sort of retail base, right? Yeah. Why can't we do something like that? And then also going down the value chain and the supply chain in particular through to SMEs. And we just introduced barriers of entries that have really prevented from that participation. And I think that if we include those participants, that they can then provide the necessary liquidity and actually start to, like as you said, Chris, help the market to accelerate in a forward momentum and direction. Corporates then follow on suit because now they have a fear of missing out and an essentially lack of supply that's accessible. Thoughts?
I'd probably challenge one or two things you said there, Rene. I agree with most of that. I would say that right now the market, I'm not sure that it does lack robustness on the demand side. It really lacks like the accelerated scale that you mentioned. But given like all the noise in the past couple of years around real and perceived integrity and the role of just, carbon markets as a climate solution at all, demand for carbon markets should have gone to zero. And it didn't. Like last year was a record for demand, but just off a low base. And so what I think the phenomenon is that we're not actually, despite, I think perceptions to the contrary, we're not actually seeing large numbers of companies leave the market. What we're seeing is large numbers of companies who've been given permission by the keyboard warriors to wait. And so they've been given permission not to start to meet the commitments that they've made, either internally at the board level or publicly. So I think the demand has held up robustly, but just off a too low base. On the CDR, like I'm torn on this. I don't want to be one of those people and won't be one of those people who, criticizes one technology to support the technology that I like, which I think some of the CDR folks have been guilty of. If it's not...
Agree. I think there's an implicit bias.
Removals, it doesn't count. Well, that doesn't help. Like the bathtub is overflowing. And if you just invest in CDR, you are emptying an overflowing bathtub with a spoon and not turning off the tap. Turn off the bloody tap, which means investing in avoidance and investing in removals. So absolutely celebrate the investment in CDR, but not at the exclusion of other technologies, because the number one thing that human beings have to do, two things actually we have to do, is it's actually pretty simple. Solving climate change is pretty simple. We've got to stop lighting stuff on fire, and we've got to stop chopping down trees. And we have to pay people for both of those things.
I mean, yeah, I couldn't agree more. But what we need to learn from that way other commodity markets have scaled, and the breakdown points that they've engaged along the way. Commodity origination is not a straight line. It is not a smooth adoption curve. It's a competitive marketplace. You're going to get multiple different fragmented points of entry and a very heterogeneous qualities to the market. It's not dissimilar to the full suite of energy asset classes we'd seen previously. If you look at how the coal, the oil, and the gas market developed in its formative primary stages, and carbon is exactly the same. You're going to see periods of immense growth, and then you're going to see periods when there's the macro cycle in play, where there's potentially high cost of living, inflationary macro conditions, and there's less enthusiasm for what would be a risk-on discretionary commodity, particularly one that has such an emotional and philosophical component to it. All that means is that the rubber band effect when you get to the end of that cycle is so much greater. And we're going to see a dramatic step change when we get to the end of this populist period, be it Trump, be it whatever happens in Australia, be it what's happening in Europe, and it just doubles down even harder. And if you study the way emerging asset classes emerge, it happens every time. And we are all on that's going to play out in global carbon markets over the course of the next 5 years. So I think there's a lot of smart money that's being very considered about how to strategically invest in that position over time at the moment. Of course, there's still an audience on the demand side which is unsure of what their focus was. It was partially kind of consumer-led discretionary marketing at one point. Now it's easier to do nothing than to do something, but a very goodly portion of them are also falling under compliance regulations. Here in Australia, the largest compliance buyers have stopped buying, the voluntary buyers have stopped buying voluntary because they're now required to buy ACCUs under the safeguard mechanism, under a compliance mechanism. As a result, they don't, that they see that they're going through that transition under a regulatory impost, and it's probably easier organisationally for them to operate in that manner, as opposed to having to due diligence everything and to run it through the marketing department or the sustainability department. So it's I think it's we just have to be aware that it is not going to be a straight line, and it's a competitive marketplace. The CDR guys are going to tell you theirs is the best. Rich is going to tell you his portfolio is the best, and so does every other one of our clients.
I'm not going to tell you that. I'm going to say do everything everywhere all at once. And I think you just hit on one of the big problems is we have allowed carbon, and by extension climate action, to be seen as a discretionary commodity. It's one of 4 commodities that are existentially important, that have no substitute, and that can be traded in large and liquid markets. You got food, energy, water, and carbon. And somehow we have managed to let carbon be seen as a discretionary commodity. It's not. We absolutely have to take it out of the sky and stick it in the ground. There shouldn't be any discretion about that.
And do you think that's because of the perception around quality, right? I mean, that's hit the market this past few years. You have folks like the Guardian and Financial Times and Bloomberg kind of putting out articles about, junk offsets or, so is this perception of quality kind of what's impacted,
I reckon it's a good question. Eddie, you mentioned the Trump tariffs. That's obviously the macro thing. But honestly, nobody on this call or watching this call or in the world knows what's going to happen with that. If they say they know what's going to happen with that, they're either deluded, lying, or just making it up. No, nobody knows. And then, so that's the macro uncertainty that's hard to solve for. And then there's a whole bunch of micro uncertainties. Look at, Chris mentioned the compliance markets before. Think about Corsair as a proxy. I like to think about Corsair as a proxy for markets overall, because those credits are typically originated inside the VCM architecture, but are also usable in Corsair, which is a compliance market. And there's multiple layers of uncertainty around that. And you mentioned integrity. The ICVCM, as you said, just mentioned, has approved some of the Cookstove methodologies in the last week, but put a pretty high bar on things like FNRB and utilization and monitoring that will make originating supply for Corsair eligible cook stove credits significantly more expensive than they were before. And so what does that do for the willingness to pay for someone who's got a CORSIA obligation? Are they just going to buy, do they care about quality? Or do they just care about least cost compliance? And again, this is going to vary depending on the buyer. And some people have decided that quality doesn't matter. So, Mercuria is marketing the Trees Guyana credits. They can be high quality credits if we've decided we don't care about additionality, or that we're only going to impose additionality rules on project level RED instead of jurisdictional RED. Like, it is completely reasonable to say to a country or a community, great job protecting your forest, here's some money, keep it up. But if you're going to do that and effectively discard the additionality test, then you've got to apply that fairly to all nature-based project types. So you've got all this sort of levels of uncertainty, and who really gets to decide whether something is high quality? Is it the ICVCM? Is it the ICAO tab? Is it just the buy side of the market? So you've got all these multiple layers of uncertainty that depress prices and suppress investment. But there's also things that we really do know, which was why we're so bullish on it. So I think, yes, it is a bit about integrity, but it's also just about like individual and collective corporate behavior. The market should never have been as vulnerable as it was to one or a small number of negative stories in one newspaper. The VCM is the world's oldest startup. It's been going for 25 years. And it's scaled a lot from a low base, but it needs to go way higher. It should never have been in the position to have been as vulnerable to criticism from one newspaper. And what it could have done and needs to do is have a more clearer and more collective, coherent articulation of why carbon markets work, why they're important, when they should be used and when they shouldn't, to give those individual CEOs, board members, sustainability officers, the confidence to do the right thing with confidence. I don't know what you think about that,
Rich,
Rene. Or Chris?
Rene, you go.
You go, Chris.
Very well. Either of you guys want to jump in?
Look, it's hard to argue with, but I think we really need to form a view on what is a natural graduation from the role of the voluntary market to compliance-led markets. How does it sit together, and what is the underlying, what was the underlying imperative to buy in a voluntary sense? It was led by consumer-driven organizations that were trying to lean into a climate action. They were trying to connect with their stakeholders. They were trying to connect with their shareholders. They're trying to connect with their consumers. In a world where we were largely absent of a global alignment and agreement on the climate change imperative. And now we, I think, are irrefutably beyond that. And the scalable imperative to buy has to be economic. It has to be economic to the point where you can see that if you don't buy, you're missing out on a fundamental investment imperative as an organization, as an investor, as a trader. And that is what takes things to that next macro scale. It cannot be, a kind of a integrity-driven sort of notional thing that sits in this quasi-voluntary space. And so we need to consider, are compliance markets the only way to take that to the next level? Because you can see a clear supply and demand framework. You can see that growth of the market, and that there's, at the end of the day, you've got a defensible investment strategy. I just can't see how we could expect the voluntary market to take things beyond that scale, because it just will not have the resources to be able to build the tools, the infrastructure, the capability, and the regulation to ensure that we don't end up in the same integrity conversation that can be rise and fall off the hand of one newspaper article that was written by a 21-year-old that's just trying to make a name for himself.
So that assumes that policy regulation is going to be stickier and more enduring than non sort of regulatory or policy approaches. And we're in a situation now where, according to some commentators who work on this stuff, for the first time in our lifetimes, the US is the largest source of geopolitical risk globally. Like nobody would have imagined that 2 years ago. And so, talk about Article 6 and compliance markets. The entire purpose of Article 6 is voluntary cooperation. That's its core tenet. And so companies should also be, if not forced, then encouraged very strongly by their customers, shareholders, staff, stakeholders, etc., to do their bit to voluntarily cooperate, even if they're not required to do so by law. And I think you mentioned the integrity stuff. I think you're right on that, in that the presence of the Integrity Council for the voluntary carbon market and the VCMI and other stuff doesn't create a why for companies to do the right thing. It just removes a why not. And we need more social pressure. Yes, more, laws and regulations, but we can't really control like macro level, policy for consumers. What we can control is our ability to, articulate how this market works, to do good projects, to invest and trade with integrity, to make this an attractive proposition so that companies will be persuaded to do the right thing, and their customers will be persuaded to demand that those companies do the right thing. You can't rely, I don't think the compliance market convergence is super important, but I don't think that, the last 52 days since the inauguration have shown that I don't think you can rely on existing policy to be the sole driver of demand.
Couldn't agree more on that point, Rich, because we've seen it for a very, very long time. Like you said, it's the oldest startup in the world. I like that soundbite. We've been waiting for 30 plus years for convergence with regards to policy direction. It took 10 years from the ratification, like Paris Agreement, to actually getting the Article 6 rulebook and then the actual implementation underway. So we know that they move at a glacial pace, they being the policy directions, and then ultimately alignment for those, and then conversion, and then ultimate fungibility takes even longer for that to just state. So the voluntary participation piece is an imperative, like you've just highlighted. I think one thing that I want to highlight, and I want to just kind of get your opinion on, is we keep talking about quality, but quality is highly subjective, right? And it's very hard to dictate, like you said, this line in the sand of high quality, low quality. Integrity is a little bit more objective, but I guess it's still kind of going up that value chain. I think the most prescient and kind of relevant lens to look at things through, and I want to get your take here as folks that are well versed in the financial markets, is the risk adjustment, right? Like a risk lens for just risk adjusted returns effectively for carbon markets. And I think that that's been undermined really by this volatility quotient, right, as the denominator there, and it's unlike other traditional asset classes where we've got that risk being I guess quantified through available data points, etc. In the market, there's this uncertainty because of the evolving regulations and the stickiness of the demand that is essentially undermined the risk adjustment piece. And when we apply it to risk on a quality kind of lens, like what ratings are doing, right? That's I think helpful, because it allows for the projects underlying to then be graded on a curve around the risk adjustment component. And what we're looking at it typically is overcrediting risk, right? Which is the big one for RED Plus. And what you need to see in this transition from the old methodologies to the new methodologies is this shift towards a lower risk quotient that then builds up more of a demand signal for those credits. So what are your thoughts?
I mean, new RED Plus under VM48, it's probably uninvestable. I think they've probably swung, certainly very difficult for existing projects to transition.
Well, we haven't seen any projects transition to date, right?
Yeah, and we've done a lot analysis on a lot of projects, and from today's levels, you need willingness to pay probably 4x before you even break even
Agreed.
on price and volume, because the value of as project developers understand, the value of a project isn't volume, it's volume times price.
Mm-hmm.
And so you need significantly higher willingness to pay than we see now. And so I think that's probably gone too far the other way. I think that it's risk adjusted returns, but it's also impact adjusted returns. And so what we can see, there is, I think, now a willingness to accept a lower absolute return for investments in carbon markets. And by carbon markets, let's just say it's Corsair or similar projects or VCM. A low absolute return for some more de-risking in there, and that de-risking can take a few forms. So 5 years ago, maybe not even that, 3 years ago, that was a few speculative carbon funds set up, buying sort of blind pool capital, blind pool allocations. Or buying the Crane ETF and a few other funds buying the GO and NGO, looking for supersized absolute returns. Where you're seeing the capital now is not expecting that I want to do a 5-bagger or a 10-bagger on my speculative money. I'm happy to make a low double-digit return for investing in a portfolio of high-quality projects that have been de-risked at the front end through good quality feasibility and pre-feasibility and project design, and then at least partially de-risked at the back end through quality offtake in place, which then serves to lower the cost of capital in the middle of that stack. So I think you're seeing more money go in that direction rather than sort of speculative money that got honestly wiped out. So the tourist investors were cleaned out in 2022 and 2023. You're seeing more patient capital into low risk projects, but there's a bunch of stuff that is difficult to de-risk, and investors just have to know what they're getting in for. So broadly speaking, you just look at nature-based projects, for example, carbon richness and sovereign risk are highly correlated. The carbon exists in emerging countries, some of them least developed countries, 30 degrees either side of the equator. And there's not only national, sovereign risk and policy risk, there's natural disaster risk and community risk, and all of these risks that mean that investors should do two things. I think invest either with a specialist, advisory firm like Valaterra or a specialist asset manager like ourselves to mitigate that risk, but you can't take it to zero. This is not a bond market, but we are seeing, I think, investors trading away potential for absolute returns to realise those, lower absolute returns in return for a bit of risk de-risking.
Yeah, very well said. And is there anything to be said about the additionality of some of these projects, right? Because we're seeing some projects emerge that have multiple levels of income streams. And this is what a lot of the institutional investors seem to have an appetite for, something that they can get 5 to 6% return on their cash from the intrinsic value of that underlying business. And then the carbon credit revenues falling on top. Because without most of the projects, in the market, obviously they're solely dependent on the sale of carbon credits for their revenue. And for a lot of private investors that are on the sidelines, that's just too much risk for them, too much risk to take on without a proper offtake in place.
This is interesting, Eddie. This is a really fundamental shift towards a more intrinsic asset management model, and it's happening across the board. I think we're seeing return to that agri-business model where you're managing multiple value streams and stacking multiple revenue streams within a carbon business, and be it nature, biodiversity, carbon on the climate side, sitting alongside, be it proteins or beefs or grains or other and obviously the land is the asset, and a whole suite of community and cultural benefits as well. Being able to identify and manage in a more sophisticated way, that investment model is certainly the trend. Certainly the trend we're seeing here in Asia. Absolutely the case in Australia for the next wave of land management projects. And I think it is a function of what you need to see beyond the avoidance projects that we're well across in the context of RED. when you move into interventional projects that require, plantations or environmental plantings and high capex projects, you need to find the sensitivities between what is the other business case for that land use. How are you going to convince a farmer in a high agribusiness growth environment where beef prices are looking like they're going to double over the next 5 years, triple over, absolutely going exponential, to step away from their conventional farming models to plant out trees on a carbon revenue line of mixed kind of voluntary and potential pre-compliance outcomes. It's that creating that hedge around the different value inputs to the model is a really interesting and I think more sustainable business model, and that's where we're seeing a different audience of proponents. It's more a project management model and more of a kind of infrastructure type model where you're able to build a long-term business as opposed to have a smaller engagement in the projects. And I think that is where we will see really great transfer of capital. We'll see real impact on land values, and that only bolsters the investment case. Australia's a bit different because it's a baseline and credit market. So it's similar to the American markets, where they've got a suite of project project methodologies that's quite pertinent to. But yeah, we certainly see that as a key part of the future. Now, the sooner we can unlock the broader value of broader co-benefits and biodiversity values, which of course are in their nascent stages in terms of being a meaningful economic revenue line, the faster we can scale that. And that is something I think is super exciting.
But that's what's happening, Chris. But I reckon that's partly because of personal risk aversion for, in portfolio managers in pension funds and other investors, rather than sort of rational risk aversion or returns optimization at the portfolio level. If you wanted to optimize returns, if you had $500 million to invest in land and carbon, what you should do, inverted commas, depending on lots of things, is invest $450 million in land and agribusiness and $50 million in pure play carbon. That's how you would optimize the returns, I think, of both of those things. The problem is, I guess the reality is, it's not as much a problem. Let's say the carbon goes to zero. So in your portfolio, you've lost, the value of your $500 million investment has gone to 450, still a 90-cent NAV. Nobody's getting fired for that. But if your 50 million goes to zero, someone is getting fired for that. And so they just go and allocate, to a broader, more real assets a play, which is suboptimal for both the agribusiness and the carbon, but is less likely to get them fired if it goes from 500 to 450.
I don't agree with that, Rich. I don't agree with that. Looking at these different markets and models in silos is part of what is the structural detriment of scaling carbon markets. We need to understand the interrelationship between agribusiness and climate and sustainable practices across the board. These global agribusinesses are facing a much as big a demand side scenario around feeding the world as we are in terms of what we consider should be the demand for carbon to stay aligned with a meaningful climate trajectory. Louis Dreyfus, Cargill, they are gigantic companies, and they in different parts of the world they'll work through different models. In America, it's very much an insetting model. If they do not find a way to create sustainable climate impacts around their usage of water, land, and agriculture, this whole carbon thing goes out the window anyway. And so
I'm not saying
separate business models is not.
You need to integrate land use you need to optimize land for all of its highest and best economic, cultural, ecological uses. I get that, but from a pure asset allocation point of view, I think it's risk aversion at the portfolio, the personal level is driving a lot of that decision making, because you're spending a lot of that is being driven by the demand to get access to carbon markets and natural capital markets. You don't need to invest $500 million to get.
But don't you want the natural hedge? Don't you want the natural hedge that you've got multiple kind of you've got multiple risk management devices
around? You're still getting that at the portfolio level, if you allocate, I'm saying allocate 450 and 50, you don't need to just allocate 500. And to Eddie's question on the like financial additionality, the financial additionality test is one of the dumbest things that anybody has ever invented.
But I think David Antonioli put his hand up on this, right? Like, because it's been adopted basically from the CDM into the voluntary market, and you're absolutely right. It is a very subjective test, right?
Yeah. Whoever came up with that has never invested 1 cent in an emerging technology in an emerging market.
Yep.
You know.
Yeah, but that's why we see projects today being so reliant on the carbon revenues, and with the prices of carbon coming down, making them uninvestable.
Which is part of the problem.
Which is inherently it. So I think that's the crux of it, guys. It's this additionality issue.
Yeah, if you plant a tree, you measure the carbon on day. This is how it should work. This is not going to happen anytime soon. But the simplest way to deal with this is you measure the carbon you plant a tree.
Mm-hmm.
You measure the carbon on day 1. You measure the carbon on day 365. And if it's gone up, you get paid. The end. Even if that was a complete fluke, there's more carbon in the ground, you get paid. And the idea that, somebody is, sitting behind a desk, at a standard or a ratings agency, working out that for a particular investor, the appropriate, capital return on a mangrove restoration project in Senegal was 33% instead of 28%. And therefore, there's the additionality of the project is compromised, completely ignores the reality of investment decision making in these technologies in these places. Silly.
Yeah, and actually, so we will bring on David Antonioli, who was formerly a Verus CEO. He wrote a really interesting thought piece on this, and essentially just acknowledging that this is a broken component. It's a bug. It's not a feature in the market around the inherent flaw of on these hypothetical scenarios, right? Like you said, well, that the project cannot otherwise go ahead if it wasn't for the carbon revenues. To your point, like if it's demonstrating an outcome that is measurable and verifiable and repeatable, right, then it can actually then generate the carbon outcome, and that's the test. So I think we should get David on the show, Eddie, and we can kind of talk about it. But to your guys' point, like from an investability perspective, we've spoken to a number of large financial institutions that have raised pretty large quotients of capital and are looking to even go like larger, to Chris's point around agricultural businesses, and that are intrinsically then tied to the carbon piece, right? There are unusable parts of land that could actually be productive with regards to fencing, protective around, invasive species, et cetera, for then reforestation that can be accretive in terms of additional revenue streams that then helps to make the usable, pastoral components of their land even more effective. And so it's a better outcome. But many times those projects from a carbon perspective don't pass the additionality sniff test.
Yeah,
and that's just crazy because we're just turning money away.
And maybe we can think
the buy side's there.
Back to 25 years ago when, scarce resources for climate action and people hand-wringing about the fact that, oh, gee whiz, if this project gets up, we don't want to risk diverting very scarce resources from to a project that, gee, may or may not have happened anyway. And whether the market is sort of oversupplied or undersupplied, and whether we should be like concerned about things like financial additionality really depends on your frame of reference. The market is either, let's say there's 800 million tons of unretired inventory just in VCM markets. That's either a really huge number because it's about 4 times annual demand, or it's a minuscule number because it's about 5 days of annual emissions.
Yep.
And so we should keep that like macro thing in our minds when we're deciding whether we care about additionality or not. We're currently talking about if every single carbon credit issued this year was of low quality or delivered no additionality or whatever it was, whatever it is, it would hold back emissions reductions or climate action for about 26 hours. What we need to do is focus on the fact that net zero means 50,000 million tons of emissions reductions every year forever starting now. And we should be trying to motivate every single investment in every project that we can, and not agonizing over whether the appropriate cost of capital for a mangrove project in Senegal was 20% or 25%. Just pay them for success.
But that goes back to what is the imperative, the investment imperative. And that whilst we need a revolution, a groundswelling kind of revolution from the constituency and people to be mobilizing on their feet, that's just the kind of emotive and existential kind of reality of the cycle in which we go through as people grapple with this kind of this whole challenge and what sort of discretionary investment, be it personal or financial, they're able to make. At the same time, yes, we need an absolute supercharge in terms of top-down regulatory drivers that can meet those sort of targets. But we get overwhelmed talking about the kind of incremental kind of scalability of these things, but at the end of the day, we need a complete breakdown of global economics as to how and as to how this works, and it's only going to come as a function of climate risk and adaptation risk and loss and damage exposure to be able to really restructure those economic drivers. And that's why I guess you just got to keep shouting it from the rooftops in terms of what that looks like. But it will happen. It cannot not happen. That that climate risk and climate transition risk is just so great for any smart business that they can't not be looking to completely revamp the way they manage their supply chains. And that won't be investing in pure play carbon. It'll be going, well, hang on, where am I getting my beef? Where am I getting my infrastructure? Where am I getting my building supplies? Where am I getting my shipping, my aviation? And how does my entire energy matrix look across my organization for the next 50 years? It can't not happen, Rich. And when it does, it's, we're going to see that 50,000.
It cannot happen. It cannot happen. It's just a horrifying consequence.
It'll happen. It's just whether or not it's too late. At some point, everyone's going to be in a panic storm.
Yeah, you hit on it there. I think people actually don't, understand how close, let's just use carbon markets and restoration projects as an example, how close that is to the real economy. So the global economy is a planetary scale Ponzi scheme. We are using both the fiat wealth of future generations by borrowing debt that we will never repay. The US debt is $35 trillion. The principal of that will never be repaid. But we're also using up their natural wealth. And so it eventually works like every other Ponzi scheme. It's great unless you're the last, generation of investors through the tent. Where sort of nature markets, natural capital come in is that the way that ceases to become a Ponzi scheme, or one of the ways, is by capitalizing on the fact that we have two commodities that are infinitely abundant and free, which is CO2 that we've already emitted and sunlight. And so a massive investment in land restoration doesn't generate carbon credits. It literally generates the primary production that is essential for all economic activity: food, water, clean air. 3 building blocks of every single cent of income of GDP that's earned in the economy. And so the better we can have people understand that, to your point, Chris, about integrating carbon markets and other land uses, the better. Because, as you said, until we start to make those massive investments, the Ponzi scheme just keeps going until, like all Ponzi schemes, it collapses. And it's not going to be gradual. We'll wake up one day and we'll find there's no food.
Isn't that already happening? I think everyone kind of agrees. So certainly we all, I couldn't agree more with what you're saying. That just seems so obvious that's there's those precious commodities of which we need to harness in an appropriate way that impacts what are the key performance indicators for all of our investment models. But it just doesn't happen. And this is a point in the conversation where I start to melt down. Like, why are we still having that conversation? Like, why are we still going through this cycle?
It's not good for your mental health to keep wondering about that. It's not a huge amount of money. We've got UN target for 2030 is 1 billion hectares. Call that $2,000 a hectare, $4,000 a hectare. $5,000 a hectare. It's only $5 trillion. That sounds like a lot. It's 5% of GDP. You spend 5% of GDP to stay alive and keep the other 95%. We're all extremely frustrated that doesn't seem like an obviously good deal.
Yeah. And we could certainly dive into this topic for another 4 hours, but given the time constraints, do we have time I want to jump into the ACCU market really quick and get your guys' thoughts and opinions, as we're, obviously we've seen voluntary demand fallen sharply in the market, and there seems to be, from quantum, traders are hoarding ACCUs. Traders that are hoarding ACCUs are now stuck as the expected price recovery hasn't materialized. And there's a lot of uncertainty around the upcoming Australian federal election that is also weighing on market confidence. So would love to get your guys' take on the current state of play of the ACCU market, and where do you believe it's heading, and what factors will determine its next move?
It's one for you to go first, Chris. I think I'll just pull you up on one thing there, Eddie. Demand for voluntary hasn't fallen, it's growing. But Economics 101 says as inventory rises, prices fall. So the demand just hasn't risen fast enough yet to eat into the inventory. But when it does, prices will respond quickly. But there's none better, in the world and in Australia than Core Markets and Chris on ACCUs. So over to you.
Oh, thanks, Rich. Look, we have a range of crystal balls in here, and they're always wrong. But I'll tell you what they say. The ACCU market is booming at the moment. I mean, it's duck legs underwater in terms of the price, because yes, we have been very range bound for a number of structural factors as to how they've designed the CAC breakout mechanics. But if we look forward to what potential interventions may look like around the election, a lot of them relate to specifically those issues around how the CAC breakout windows could be changed or affected, and what that will do to the near-term supply-demand forecast. Regardless of that, you have 218 liable parties that have now really started to kind of work out that they're going to have to deal with some origination level primary supply. Otherwise, they're going to get caught in a short squeeze. And that short squeeze is a function of the rate of change in which we've modeled around industrial decarbonisation and the volume at which these new supply methodologies are coming into the market. It could really pop come 2028, 2029. And as a result, there's a lot of work going into upstream investment, looking at early stage origination, land acquisition. Environmental plantings is the new marginal supply side methodology, and that's a completely different business model, a completely different audience of project developers and types of landholders that might be suitable for. So it's a really fascinating, exciting time for the market, albeit the price hasn't moved around too much because we've been stuck in this range-bound focused. Last few months is very much trepidation around the federal election. Looks like it's in May, and people just dealing with the kind of near-term imperative. We had the SMCs into the market that allocated by the government just over the course of this last 3 weeks. That was a larger volume than was expected, some 8.2 million SMCs. So that's certainly had a kind of bearish tone to any kind of last minute buying that we would have seen up to annual compliance. But beyond the federal election, if we have anything other than a coalition majority, and they have made some clear signals about what sort of changes to the Act that they would implement and how that may change the demand horizon under the safeguard mechanism, anything other than that is extremely bullish, and it's an extremely exciting stage gate. And look, $1 billion of value has gone into Australian agricultural land value as a function of the safeguard mechanism. Property prices out the back of New South Wales that were previously goat herding country have tripled, and there's a profound amount of economic rejuvenation has happened to all manners of regions as a function of the project mechanism. So I can't see the coalition government rescinding that premise. It was emissions reduction fund was actually Tony Abbott's implementation in the first place. So we're still pretty bullish. The key piece and the one to watch is what happens with these CAC contracts. We call it the CAC hole, all the undelivered CAC contracts that have been laid out through the market. You do the maths and it is eye-watering in terms of the CAC contracts to the government that are undelivered and will probably never be delivered, 5 years behind, 6 years behind. If they make a key acknowledgement about if they let that supply contract out or if there's some obligation to fulfill on them, that is the key driver that changes the model. And that's the one to watch. We can bore you senseless about it here with our analysis and our kind of assessment of the market. Happy to do so anytime. But yeah, we're really excited about it. I think, look, there's been a lot of traders and proponents at book building positions to get in front of this forecast demand. Obviously, if you're sitting in Singapore and you're a proprietary trader, you always want things to happen faster than they do. But we still see that being a meaningful trade.
Can I double click on
do you want
that,
to touch
Chris?
on what a CAC is?
Yeah, I was just about to ask you. So like it's carbon abatement contracts, but can we just double click on that? Can you explain what you just talked about? This
it's a whole
undersupply?
episode in its own right, I guess. But what happened before the safeguard mechanism was designed and implemented, which is the regulation that puts a liability on 218 corporates, we had the emissions reduction fund where the government gave 7-year contracts to supply side proponents, and they were called carbon abatement contracts. You delivered just to the government, and the supply was going directly to fulfill on a government contract. Those contracts, many of which have played through, were primarily 7 years and 10 years. A lot of those contracts missed their start date in terms of not delivering. For some reason, the project didn't start verifying, didn't start issuing, and are years behind in terms of what those volumes are. There's obviously 3 major developers. If you do the analysis, it's pretty apparent that those projects are never going to start delivering. And so there's a hole in the government's committed contracted volume of tens of millions of ACCUs. Now, theoretically,
hence the term the hole.
Yeah, that's the whole. Yeah, so obviously, yeah, excuse my turn of phrase, but it's standard nomenclature here around the office. But that is a really fascinating juncture as to how the government grapples with that. There's been some pushbacks around the contracts, but in the premise, if you have a contract and you have to make good, liability on a contract as if you would in a proprietary contract if you were dealing with a bank, that's tens of millions of ACCUs worth of demand that should return to market in addition to the undersupply. So that is, that's some staggering stuff.
So who has to cover that short?
Well, it should be the supplier, but unfortunately, it probably won't be, right? Because it's going to end up being the Australian voter is the out of the money short in the Australian carbon market. But I think will come to a happy medium as to how they manage the transition of those. But in doing so, that will fundamentally change the kind of metrics of what the market looks like going forward. That coupled with the new supply side constraints, obviously IFLM, there's some of the specific methodologies have been delayed, and
soil
they're
carbon?
not looking to yield. The soil carbon, of course, is there were some big numbers thrown around in the early days, and that's always going to be more complex in its formative stages. It's harder than it looks. Obviously, building a sustainable origination model in the current market. Environmental plantings is the forward-looking marginal supply activity, and that's above $40. That's a long-run marginal cost today of the mid-40s and upwards from here, escalating. So how can the sorry, my button pops out.
Keep popping the button.
How can we not gravitate to that price if we're going to meet the 2028-29 liability periods? It's a fascinating time. Stay tuned. Anything but a coalition majority, and it's a bullish scenario. And it's a coalition majority. I think that's a long shot as well.
Who knows? I think, Eddie, it's Chris made a good point there.
Yeah,
you mentioned, investors or traders hoarding credits. That's not how I describe it. You don't say that, investors are hoarding gold or hoarding cash or hoarding stocks. They just have inventory on the balance sheet. And I think if acting rationally, if projects are hard, right? And, the simplest way, I think, for anyone who's interested in the Australian market, and there's the way processes that Chris mentioned before, there's a functional floor price on ACCUs of maybe what, Chris, $20, 21, something like that. So, you're long at 33 Australian dollars. You've got maximum downside of whatever that is, 30%, uncapped upside. Just buy spot.
Yeah, fair enough. By spot. But what about the futures? Because now you've got ASX and our old friends at Expansive on the spot, obviously launching their contract, but partnering with CME for another futures. So you've got ASX and CME having ACCU future contracts. There's not a lot of open interest on those contracts, but now that also provides the ability to hedge, right, Rich? So if you're unable to secure supply on the spot or via short-term forwards, to say bilaterally, doesn't that now open up a window for kind of putting on bets
if you want to have
in
more
the future?
sophisticated tools for hedging and for leverage? It's been one of the challenges of the international markets. There haven't been those sophisticated sort of hedging tools. You can do. There's plenty of bilateral calls, OTC calls in the market. But yeah, certainly the ACCU market. It's not unique in the world, but it's close. It's sophisticated, first world, services based, OECD economy with a credit-based market, and that has Australia and Canada are the two countries in the world that still have, sophisticated first world economies and massive intact landscapes still owned and managed by Indigenous people. And so you have this real opportunity not only for for the market, but for those Indigenous communities and peoples to benefit from that market. So we're with Chris. We're bullish on both the impact and the economics of the ACCU market.
Yeah. Well, with that being said, I think I want to be conscious of everyone's time, but I want really thank you guys for joining today's podcast. It was a really great discussion, and I'm excited to see the clips that come out of it. But yeah, that should do it. That should be a wrap.
Aren't you supposed to say smash the like and subscribe?
That like button.
You missed like podcast 101. Don't forget to smash that.
Oh yeah.
Smash that like button.
Smash that like button. That'll go to dark.